Good morning. This is the Eye of the Storm podcast with the Elliott Wave weekly update for the S&P 500, being recorded on Saturday, October the 4th, 2025 at 9:05 a.m. Pacific Daylight Time. As always, I'm going to start here on the SPX, that's the cash market. I'm on the largest amount of data that I have, so I'm on my maximum monthly chart. And just to do a very quick review of where we are in terms of that large picture. Again, I start with the Grand Supercycle, which is very large, and that is, and I place them where R.N. Elliott placed them from his original works, and that's where I started as well. So we have Grand Supercycle Wave 1 completing in 1929, Grand Supercycle Wave 2 completing in 1932. And from there, we start within a Grand Supercycle Wave 3, which actually is still in motion. So Grand Supercycle Wave 3 was going to consist of 5 waves of supercycle degree, of which we have 1 and 2 complete. So we're in Supercycle Wave 3 of Grand Supercycle Wave 3. So what is that supercycle going to consist of? 5 waves of my cycle degree, of which we have waves 1 and 2 complete, and wave 3 nearly so. So once we're done with cycle wave 3, which I think is going to be coming within the next month or so, then we will have completed and be in cycle wave 4 of supercycle wave 3 of grand supercycle wave 3. So you can see that we still have quite a bit of upside left to do, even within the cycle degree. So what can we expect from this cycle fourth wave? Well, the first thing I've done is I've placed it here. Now, I realized that I had put previously a green box here, and that was actually incorrect because it's not the primary fourth wave that I'm looking to come down here, but the cycle fourth wave is where I'm looking to bottom in here. So I'm going to refine those levels. So ultimately, yes, I do think that cycle wave 4 has a high potential or probability of reaching its low within the price territory of the fourth wave of one lesser degree, which is the guideline, and that would be primary. Again, we're dropping in a cycle fourth wave. That is going to be labeled with that color, that reddish color. And so that's why I've changed the color of this box. This is where I believe cycle wave 4 in its entirety will bottom, will finish within this price territory here. Okay, so I'm going to quickly just bring this down now because I'm going to begin my conversation about, well, how close are we, or what can we now wrap around this final phase up for cycle wave 3, for that top of cycle wave 3. So I'm going to immediately come down to the 5-year weekly chart where I have intermediate wave 3 and intermediate wave 4. Again, just very quickly to continue that. So here we are. So we have within cycle wave 4, we have 5 waves of primary degree, of which 1, 2, and 3, and 4 are complete. So we're in primary wave 5 of cycle wave 3. Now, bringing this down, what's going to be inside that primary wave 5? And it'll be 5 waves of intermediate degree, of which 1, 2, 3, and 4 are complete. Wave 4 bottomed in October of 2022. So from that point, we have been tracking and tracing out an intermediate fifth wave. That fifth wave up will complete the primary fifth wave and then the cycle third wave. So I've changed the color on this box as well. Why? Because within cycle 4, it's going to consist of an ABC of primary degree. And so I'm thinking this is where primary wave A, that initial decline, is going to come back to within the price territory of the previous fourth wave. Again, for the larger cycle 4, but if I break it down, I'm going to look for primary A to follow that same path of finding its terminus, its endpoint within the fourth wave of one larger degree. one lesser degree. So if I'm coming down in a primary, one lesser degree is intermediate. So again, using that same guideline to put in where I believe that primary wave A will come in. And we can see that low is, is just below 3,500. So again, yes, it's a large drop considering that we're trading at 67.15 right now. And we're going to go higher. Before this is all said and done, we will go higher. Now, I want to begin my conversation. So we're in intermediate wave 5, and it's going to consist of 5 waves of minor degree, of which again, 1, 2, 3, and 4 are complete. Minor wave 4 completing on April the 7th of this year. So from that point, we've been rising in a minor fifth wave, and you can tell, you can see, we've all been trading it. It is very dynamic and pretty vertical, almost to the point where we likely can start to say, is it going parabolic? Yes. Is that unusual for a fifth wave? No, it is not. We find that a fifth wave will go and it will continue to go, and you start to wonder, what's it going? What's it rallying on? We're not getting buckets full of wonderful news, positive news that would show us that this growth pattern should continue, that this good news should provide excellent atmosphere for investing, for stocks, for everything that gets involved to what our economy runs on. Well, that's not the case. We're kind of just running higher on different things, but more, I'm going to say, lately, it is due to options trading, how things are trading in the options, where gamma is sitting. And so we start using a different set of what I want to say is givens to determine where a market can go and what's going to trigger it in one direction or another. And then that breaks down to the things that I do talk about and that I do use, and that's our gamma levels. These are where large positions are put that either can produce positive gamma or negative gamma. So when we're talking about a call wall and a put wall and a volatility trigger, it is really just what happens when that breaks. What does it do to the market? What what does it present in terms of, do they buy it or do they sell it? Then we can break it down even further and we start talking about risk on, risk off trading. When the risk on trade is in full motion, which it has been again up at these levels, it has been again, risk on suggests that the trading or the traders are selling the VIX, selling the VIX future. That's a cash market. So they sell that, receive that cash, and then take it and invest it or put it into the underlying components of the S&P 500 and buy the volatility of the underlying components. And to me, what does that involve? When I say buying the volatility of the underlying, well, they're going in and they're buying the calls. And so that volatility relates to premium. And so they're actually buying premium. And excuse me, so they're either buying the calls, selling the puts, but they're getting, they're doing premium. Now, having said that, what is the hedge? So a dealer, right, a market maker who has to make the market in the call or the put. And when you've got the mass of amount of traders coming in and buying the calls, the dealer has to sell the call. And what's the dealer's hedge? To buy the underlying, which again, eventually, or not eventually, immediately trips over and gets translated into the price movement in the index or the ETF or whatever's sitting underneath it. So with that, so when we're talking about the risk on, buying the underlying volatility and it's so a buy, well, it really becomes a self-fulfilling prophecy because the dealer has to buy, the one making the market, the one actually doing that trade on the opposite side of where retail or the one side is doing. So they're buying, and it's a self-fulfilling prophecy. The market's going to go up. Now, the opposite of that is risk off trading. And what is that? It's like when we break the volatility trigger, usually going down, what it's suggesting is that it's turning into the risk off trade, which is where you're now going to be buying the volatility and you're going to be selling. So, in other words, your hedge on that type of a trade is to sell. So, when we start to break below a volatility trigger, when we start to break below a call wall or a put wall, we have to understand that the gamma that's sitting there, the result is usually going to come in as a sell. So that's why when we're using these numbers and I'm putting them out at these levels, when they're broken, it can it can accelerate or accentuate the current condition in the market, whether that's selling or buying. So again, when we break the levels moving up, when we go above a call wall, when we go above a volatility trigger to the upside, well, it does then it's not forcing, but it does bring about stronger rounds of buying. To the downside, when we break a volatility trigger, when we break a call wall, to the downside, it's going to bring about an intensified session of selling. All right, keeping all that in mind. So, what I've tended to do now using artificial intelligence is to start to work out what what can we expect for the balance of this year. So you have heard me speak about that the algorithms have continued to suggest that we will see a surge higher in the fourth quarter. And so I've now refined that to bring it down to we're in the fourth quarter. So let's start to break that down as to what we think or what the algorithms are now telling us. What is the path? Where can we go? And putting some time factors on it and also some price factors on it. So, what I've done is I've given a couple of instructions. So, when I'm talking about right now, I've run it against the spiders. So again, the spiders are the ETF for the SPX or the S&P 500. And that is what I started with because I have found that the spiders and the Qs have very, very, very large options trading. When we take a look at the spiders, we're talking hundreds of thousands of options are trading every day, puts and calls and just in all combinations and everything's set aside. They're very, very heavily traded, both in the spiders and in the Qs. But today we're discussing the spiders. And then I've converted that over to be reflected in the SPX and in the ES. So here's some of the things that we're talking about. First, let me just continue off this weekly chart. We're in minor wave 5 up. Minor wave 5 will then complete the intermediate wave 5 and the primary fifth wave and the cycle third. So we're within that, and that's going to consist of 5 waves of minute degree. I'm going to bring it down to the daily chart. And here on the daily chart, you can see here we are. There's minor 5, start of minor 5. There's minor 4. We're in minor 5. We have 1, 2, 3, and we're in minute wave 4, which, by the way, produced an irregular B wave. Now, this is all on the daily. Now, you're going to see here left tails. Now, kind of what we're doing there is I'm talking about that when we talk about tails, you're looking at, if you're thinking in the world of options and you're looking at tails, tails are the out of the money calls, out of the money puts. Those are the tails that go to each side. Left tails are referring to a bearish, and right tails are the upside. They're more bullish. So we have a right tail, and now what I've asked the algorithm to do is to talk about or just put in uh, extremes. So when we're talking about, I wanted it to measure out against what we have coming here in the fourth quarter. So we can call them events. So events right now are going to be consisting of uh, what we have are earnings and FOMC meetings. Those are the event windows. And then then I take the algorithm and I ask the algorithm to give me probabilities of what could happen if that event is negative versus if that event is positive, and what kind of a move can it make? And what then I ask the algorithm to give me a probability scale for each level. So when we're looking at the right side tails, right, which again are the bullish picture. Now add into this. So we have our events. Now I had to decide what type of scaling am I going to use, and then what we're talking about is there's a volatility component, and so asking the algorithm to kind of keep that volatility consistent or constant so that as it's working through these event windows and also just basing all of the work or all of the levels on a constant in the volatility. Now we know volatility can move, right? And we know that because we watch it every day. But I'm basing it on a a base volatility, so a realized style, so what we see the most, of 18%, an 18% volatility. Now, those event windows, the earnings, the FOMC meetings, we add a little bit more, so it's 1.7 times that volatility. And what we're really doing at 1.7 is if we take a look at beta. A beta is nothing more than there's a base beta. One would be for the SPX. The beta would be 1 to 1, right? But when we're looking at the volatility that could be created or will be created in the underlying. So when we're talking about an FOMC, it's going to be against all of them, right? So that type of event has an effect on the index as a whole. So we use a 1.7 beta times the volatility. So it's 1.7 the volatility within the event window, and also as it's attached to an FOMC meeting or an individual underlying a stock producing their earnings. And that goes back and takes a look at, well, what moves has it created? So rounding that off, keeping it constant at 1.7. So basically, when I put my Elliott wave overlay, so my Elliott wave count, and I put that over all of this, what it's basically telling me and continues to tell me that there should be a bullish drift. So the market drift, in other words, the market moves higher into November the 25th. Now that covers a lot of the initial earnings reports. And we can go back and take a look at what they really are. So basically, we have Tesla earnings, and I believe that they're supposed to be reported on October the 22nd. Google is reported to be on October the 28th. The FOMC meeting is October the 29th. And Microsoft earnings are estimated to come out on October the 29th. Meta, same day, October the 29th. Apple's earnings on October the 30th. Amazon's earnings October the 30th. Again, we haven't gotten the hard and fast, like, yep, that's when we're going to report, but this is what the estimate is. And Nvidia's earnings on November the 19th. Remember, they always report late in the cycle. And then now we're moving into December. We have the next FOMC meeting that starts on December the 9th. And then we'll get that decision on December the 10th. And then Broadcom's earnings are on December the 11th. So, putting all that together, then we put it back in to the algorithm and we ask it to kind of give us an event window. And then we're looking at the percentiles of what could be created in that move, both up and down. So when we're looking at the downside, it's not as bad as you would think. So we're really coming up within a 5% percentile and then a 25th, right? So there's percentiles are the 5th, the 25th, the 50th, the 75th, the 95th percentile. And what does each of that suggest? So if we're looking at that, basis the spiders, that's what I originally ran this again, as spiders. We're looking at some returns. And actually, I ran this on October the 2nd, where the spiders were 668.89. It was the close on October the 2nd. So again, now I'm going to bring it back down. So the the deal is that I'm really running this in the window of October the 2nd to December the 31st and using the spiders as that proxy for everything and using the same event set, which is the FOMC and then big tech earnings, their clusters, plus the Elliott wave timing, so Elliott wave basis. So this is kind of what it's come up with. So also, again, using the Elliott wave, using my count, that a bullish drift into November the 25th, and then a corrective drift from December the 10th to year end. Okay, so now within this whole time frame, I asked it to break it down to how many days would be considered bullish, or we get an up move, how many days would be basically neutral, so it's kind of sideways, and how many days would be bearish. So the algorithm came out again in the spiders and the SPX. 55% of the time it'll be bullish. 30% is going to be neutral, and 15% will be bearish. Now, again, this is just an estimate, but I find it very interesting because when we look at our market, we impulsing to the bullish side. Well, yeah, we get a lot of that and we are still in a five-wave sequence moving higher. So again, 55% of the time we would consider that bullish. We're moving up. 30% neutral when we're going sideways, which we did basically when we go through a fourth wave or we go through a second wave. We have bearish components, but basically a lot of it's just sideways. So, and then again, 15% where we get that sudden drop, right? So now the event jump, so in other words, up or down as a result of earnings and or FOMC, the magnitudes versus the Qs, which is where I started. I started by doing all of this work in the Qs, and then I had to run it for the spiders. So, but in the spiders, it reflects a little bit of a lower beta. So, in other words, the individual stocks versus the SPX, the beta comes in a little bit lower than it does in the NASDAQ. NASDAQ tends to run, even the stocks tend to run on a higher beta. And that's what all beta is doing is following the volatility. So if the NDX and the Qs are at 1, the beta for a lot of those individual stocks comes in at 1.7. Now that fluctuates, but this is in general. So we got to keep this all together. Now, here we have it. I'm looking at event probabilities to year end. And what I've run it against left and right tails. Left tails, if we remember, sorry that didn't close. Left tails, as we remember, those are to what the downside tails. When we talk about tails and options and you're protecting a position, you're buying or selling a tail. And that's a out of the money call or an out of the money put. And you're putting protection on your position. So here on these tails, and again using 1.7 beta for the vol, I asked the algorithm to give me event probabilities to all the way to the year end. And so first thing we did, we're running it on the negative, so the bearish picture. And so 5%, a 5% move, which is down to 6460, through an event or a group of events, comes out at that there's a 29% probability that we'll get that. We will get a 5% move. And that just suggests 6460. Now, if I do the math, right? If I do the math and I run it through, and I'm basing that on the SPX closing on the second at 668.89. So using all that. So again, these have to be a little bit flexible. So, but basing it on the close on the second, that we come up with 64.60. And then the next one that we can count on is the 10%. So in the spiders, in the SPX, those tails are run at a 5%, showing the highest probability of that occurring. So again, 5%, 29% probability. And then we have 10% is only 15.3% probability. So here we have that, again, that left tail. So a 10%, which has a lower probability, that comes in at 6120. Now, and I know that's not exactly right, but you have to understand this is my fibs. These are the fibs for that fourth wave. But if I'm counting this tail, you're going to see how, wow, that's coming in pretty high, but barely in the price territory of the previous fourth. So now what I'm trying to do is I'm trying to put that all together and take a look at what all of this can do. First, let me tell you, we have the reverse, we have the upside. And now, one other thing, what I put these in is the color of the wave pattern that we're in. Right here to the downside, we are in a minute fourth wave down. Well, using these tails, because guess what? We're in that fourth quarter. We're in that period where we can expect these moves to happen. Now, these are the event tails, right? The event moves. So it's going to be on an earnings report or a group of earnings reports or the FOMC. And we get that sudden move. Now, again, then the probability of a downside move of minus 5%, so a 5% move down is 29% probability between now and December the 10th. So, and actually now to November, to mid-November. So when we get most of these events, right? Okay, so then what we have is that 10% window, which has a 15.3%. Now, what I try to do next is like, well, I'm just kind of looking to fit it in where my fibs are and where my previous fourth wave is. Now, the left tail, the 5%, is within that window where it comes out at the higher end of the move. Now, don't forget this is 65.23. Here we have 64.60, right into here. It's right inside it. And so I'm like, okay, so that works. So you see how the algorithm does all the math for us and puts together the probability? So there's a 5% probability that we'll get that tail that'll shove it down there. But then we have to look at, well, there's also a fairly good chance that that's where this minute fourth wave will complete. Okay, that's the other thing that I'm trying to put the time factor in here. Now, again, we'd be looking for the minute fourth wave to complete pretty much early. So pretty much, I think by the end of October. And then we start to rally again. And we rally in that minute fifth wave up. So this side, the right side tail, which again, if we look at events, I'm going to try to piece it all together, that the right side tails are, we're going to get a 10% boost, a 10% rally, or a 5% rally. Now, those percentiles really suggest that overall the upside is going to fall into a much higher percentile. It's going to fall between the 75th to the 95th percentile. And again, based on the spiders close at 668.89 on the second. So we have the right tail where we get a 5% move. And what I've done is I've converted that number from what it shows me in the spiders to where it should be here in the SPX. 5% to the upside in an event. So that's an earnings report. But also, I think that's where we can get to. Comes out at 71.40. A 10% move comes out at 74.80. Here's our fibs for, actually, this should be, I could put a little higher, but I was trying to get as close as I could here. That where on a Fibonacci basis does this fit in? Well, 3.786, that's a fib number, comes in at 7,197. That's as close as here. So I think, well, yeah, it could pop even a little bit more. But there's the tail. There's the relationship. Now, fib-wise, we've had numbers above here for a long time, right? And now I'm putting the minor fifth wave, right? That's what I'm looking for. Minute 5, minor 5. All right. So when minute 5 finishes, minor 5 will finish. So I just lifted it to that level because I actually could put this in the intermediate degree color, which is yellow, or I could put it in the primary degree color, which is green. Because once the minute fifth is done, well, that so is going to be the minor, and so is the next two up. But I'm using the minor because this is where I can connect it. I already have minor 1, I already have minor 4, so I can put that fifth wave in. I don't have minute wave 4 yet, so it's an estimate. These are a little bit more grounded because I already have minor 4 in. So, yep, I will add them once we get that fourth wave done and I can put it in. Right now, it would just be a guesstimate. All right, so this one is also a guesstimate, but a little bit more grounded. So again, those line up with fibs, and this is where I think we could finish inside here. So I'm not starting to narrow it down, cycle wave 4. So you can see we have pretty good deal left over. And now we're putting in these events that starts to show us, well, maybe this is how they come out. But we're looking at both sides, folks, okay? We're looking at both sides. I'm looking if they come out, excuse me, now, because again, the algorithms continue to suggest that we have a basically bullish trajectory through November. And then I think it was like November the 15th or something like that. And then we had from there, actually all the way up to December the 10th, your basic bullish trajectory. And then from there, from December the 10th on to the end of the year is basically more bearish. So it's, in other words, we start that downside move. So let's say between now and December the 10th is when I'm looking for this wave 4 to come down and finish. So we do have a small period where we have a little bit of a bearish view, and that would to finish minute wave 4, and then we start that surge higher in a minute fifth wave, and that fifth wave, minute fifth wave, is going to finish minute 5, minor 5, intermediate 5, primary 5, cycle 3. So that's why I've got it here. So first, I think we come down, and likely, I think we could get down here and finish this before we really start the the events that I'm listing, which are the Mag 7, the high of the big stocks within the Nasdaq, which are also the same the big stocks within the S&P. If you look at, like I tell you all the time, slickcharts.com. When you look at slickcharts.com, it's going to give you that breakdown because all of our indexes are cap weighted. And so with that in mind, who sits at the top of that food chain right now? Most of the time it's Nvidia. And if it's not Nvidia, then it's Microsoft. It's not Microsoft, it's Apple. And then also within that, we have Tesla, we have Google, we have all of them sitting up here in the top 10. All right, so let's see if I can break this down. So this is showing you the right tails, the left tails. Again, the right tails are bullish. So a bullish interpretation of what could come out from the earnings. And then also, while it was doing that, it also gave us the percentages of probability, the probability of the market doing that, of getting up there. So when we're looking at to the downside, a 5% move to the downside has a 29% probability of occurring. A 10% move to the downside, right, this other level, only has, well, only a 15.3% probability. Now let's reverse that and look to the upside. The upside's much stronger, I got to tell you. The upside, a 5% move to the upside has a 38.5% probability of coming through. Again, this is all weighed out by the algorithms. And then a 10% move to the upside has an almost 25% chance of occurring as 24.6% probability scale. So now, again, bear in mind that the beta for the individual stocks in the S&P is a little bit, is relatively, well, let me put it this way. On the buy side, so on the right side, the right tails, they are expected to remain relatively fat, as we say. So premium will be fat into the late November window, which is going to cover earnings momentum and seasonal bids because we're going into year end. So again, we have a little bit fatter beta in the stocks into the late November window. That's also interesting. So the left tail, these, tends to flatten out into November 9th to 10th. Why? If it's here, flatten out, because we're expecting the market to go down. So it's going to get flat because no one's going to be expecting it. That's going to be the interesting thing, right? Also, the tails, you buy the tails or you sell the tails. And so that's what produces those projections. Now, having said all that, I wanted to take some time and explain what the algorithm is now. I'm asking the algorithm to do is to give us that 3-month view, October, November, December. Because before it was just look for surge. Going into December, before. So, and actually now I put a time on it, or I put a date on it, and it's December the 10th. So, and then we've got that Fed coming out December 9th and 10th. So if it's going to end on the 10th, boy, I think the algorithm's kind of giving a probability of the Fed doing nothing, or basically doing nothing. And we might get another rate cut because it is showing that the November timeframe or the October timeframe a little bit better. Maybe we get another rate cut. I don't know, but we'll see. So again, trying to place all of this, what the algorithms are telling us, back into our picture is what I've done. I'm going to bring this down to the 1 hour chart. And now let's take a look at the SPX. I think we completed the minuet B wave of minute wave 4 on Friday. We hit in the futures market, we hit 6,800 on the nose. Here, we hit 6,750, pretty much on the nose. Not that that was a level, because I think in the SPX on Friday, the call wall, I believe, was at 6,800. And I think they did that on purpose. They just get it out of the way because it was sitting at 67 and we'd already went over it. So they moved it quickly and they put it up at 68. And so there would have been 68.49 in the in the ES. All right, so here we have. I put the B wave, and it looks like we did start. So if I go back down, let's take a look at that 15-minute chart. 1, 2, I'm going to say 1, 2, starting to come down in the third. So again, what should happen if we're in this third wave? We should start to accelerate, and this will be our longest and the strongest out of this 5-wave sequence that's going to be called wave C. So we have, I'll go back out to the hourly, so I don't have to scrunch that chart so much. We have our fibs in place, 100%, which should provide some support. I do not think it's going to complete the C wave, but it is a level. It's an important level. 66.19 is where wave C would be equal to wave A, but I need to add additional simply because we have an irregular. So how did Elliott and Fib compensate for that irregular? We got up to 1.236. So we would use 1.618 as our fib level coming back down because of the irregular. So therefore, that I think will come into play because number one, right now, the hourly 200 is sitting right at that same level. 66.21, 66.20, we'll call it. And that is, I think, where we'll find some support. But maybe that's just wave 3. And then we get a 4, and then we get a 5. And then again, what we have down below here at 1.618, 65.37. So we're going to start to get into these events. Where does all that come in? I can continue to build on a Fibonacci basis. There's 1.618. If it gets there and stops and starts to go back up, that's going to be acceptable, and here's why. The C wave would put in a new low below the A. That would be one of the requirements we'd be looking for. And it comes down, and if it hits this fib level, that is 1.618, and that is the most common fib level in an irregular B. So there we have 2 that suggest that level. Now, if we go further, our next fib level is 2.618, and that's 64.06. Now, I got to go out a little bit more. Here, we start to see that 4th wave. Here, we're basically, I think we start to move into it, but as we start to come down, 2.618, we're inside that 4th wave. Now we come down even further. There is the low of the 4th wave at 63.56. 23.6% retracement of the entire 3rd wave is 63.20. Now, 4.236, which is just the next level out, is 61.93. We go beyond, 382 is 6,800. Now I need to go back out to a larger chart, and there we have our left tails. Now the left tail just minus 5%, which again has a 29% probability of coming through. That's at 6460. That is going to be inside the fourth wave. Let me bring it back down. 6460. 6460 is within this wave. So you're going to see all of a sudden that probability that the algorithm is working out, it fits for the fourth wave. That's why I marked it. I think I have to go this way to get it. Let me go on to the 4 hour. That's why I marked it as such. 6460, white, minute, complete, possible. And it's coming in between 1.618 and 2.618. And it's coming within the price territory of the previous fourth. Got a pretty high chance there. And the probability of it is 29%. I like it. So are we really going to drop out of the sky? No. No, it's a fourth wave. I'm looking for it to drop, and it's going to feel like it's dropping pretty quickly or out of the sky because we're trading at 67.15. 64.60. Well, let's figure it out. It's over 200 points, right? It's over 200. It's like 250 points. That's where it comes in. And I think that's pretty realistic. Now, if we go the full bore 10% move on event, right? Well, now we're talking 6120, and we have 382 on a fib, which is most common for a fourth wave, comes in at 6088. Okay, so that's what that one is putting in place. So it just really, let me just see one thing. Let me just see one thing. Let's see what 4.618 is going to look like. There it is. 4.618 comes in at 6141. The left tail 10%, which has a 15% probability, comes in at 6120. 382 comes in at 6088. So what is this telling us? If we get sour, bad earnings, upsetting earnings, FOMC does nothing, FOMC increases, who knows? But we have a more negative reaction to whatever's going on. There's the tail, there's the fibs, and there's the additional fib. Still within a fourth wave. So I like it. I like putting this together and just realizing, oh, these are the probabilities and this is the levels. So overall, again, you've heard me for months now talk about 6,000 SPX, solid support, has been for months. I think it's going to stay there. I think it will be there to whatever comes flying down, unless we have a sheer disaster, which is going to conclude that, folks, we're done. Up here, finish that cycle. And I want to tell you, it's going to be a news event. It's going to be something serious. Do we have something growing in the geopolitical arena right now? We sure do. Am I saying that that's going to happen? I am not. In fact, I'm praying that it doesn't because it involves the Ukraine and Russia and the United States. And it's all bluster. It's all threats. And it's not pretty. Not going to go there, but do we have things that could flip this thing on its chin? Yeah, we do. But that is going to be a news event that we're not expecting. We're moving forward, looking at earnings, looking at the FOMC, putting things in that we can expect, and then putting a probability percentage around it. How hard is it going to be to put a probability of a war expanding, a war becoming regional, turning into world? That's pretty serious. I have no idea how you want to measure that other than get out of the way. Okay. So I'm not looking for that. But here's my window to the downside to complete minute wave four. Now, going back out, if I'm looking at minute wave five, well, if we get down here, we can run that, we'll run that four. And let's not forget on the daily, minute wave one was huge, right? Remember, we were all there. There was all the tariff talk, and oh, we're going 145%. Then, okay, we'll put them on pause. Then I think I might put them on pause. It might be a good time to buy. And I'm putting the quote out that was given on that day, and it came and just shoved this market, all of them, up substantially. The S&P on that day was up close to 300, right? So we take it from the low of minor wave four to this high for minute wave one. And then once we're done, we're going to shift it over and put it on, excuse me, minute wave four to get the five. And what are we really looking at? 100%, 1.618, 2.618, and then we've got our tails. This is for the minor fifth wave. And then we also have, again, let's not forget, a 5% event move, event momentum, earnings, FOMC, etc. That's what the algorithm included. We're looking at that has a 38.5% chance of happening. Pretty incredible. And here we sit. And then the 10% has almost a 25% probability of occurring. So remember, we start getting up here. Where's resistance? Where the fib sits, where the algorithm puts it. We've never been here before. This is a mathematical equation to give us these levels. How hard can we hold them? Well, they're there. So far, we've seen markets go up to them and then reverse. So I think we can continue. All right. So that's all in the SPX. Let's go over and take a look at the ES because I still have one more to do under that. I'm going to bring the spiders into focus here. Here we have our daily. And I forgot to put my left tails in. But no, I didn't. They're basically for the SPX, and I actually gave the ES for the SPX. My apologies. So I'll rerun those for the SPX. They're not going to be too much different. You just got to take the premium out. So on the ES tails, the upside, the right tails, right, are 71.40 and 74.80. And here you can see our fibs here, right? This is for minor five. 3.382. Legit, 71.21. The tail, 5%. Again, it has a 38.5% probability of occurring. 71.40. 71.21 to 71.40. I like it. Then we have a 10%. That probability, granted, it drops down a little bit, but it's close to 25%. 74.80. 3.91, all right, so basically just above 3.882, 74.79, 74.80. Wow, that fits. So these become very realistic levels for the market to reach in the futures. Now, coming down, what do we have? Again, I have 64.60. 64.60, ding, 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 right there, still the same thing. Bring it down, put it on that hourly. 64.60, 64.60, bing, right there. And guess what? I put my marker in. And where are we? Inside the fourth wave of one lesser degree. right? Minuet, 6460 fits. And it's between 1.618 and 2.618, coming in probably, 2.5, somewhere in there, or even closer. It's almost 2.618. There's 6460 right there. And what's the second one? The second one is a 10%, 6120, 0.382, 6132, 6120, not that far below, right there. Yes, it's below the previous fourth, but it's fitting because of the fib, the 382, which is most common for a fourth wave. Boom, they fit. Boom, they fit. So again, I am feeling a little bit easier that, yeah, we've got some serious pop to the downside to do. It's going to look heavy duty because if we get to 6460, we're trading at 6760, 300 points. How many times have we seen collectively the SPX or the S&P moving 300 points? Gee, let's go back to our daily chart and let's look at that. That was 300 points in the futures market. So it's all there. It's all real. It's all possible. So again, bring it back down to here. Now, once we get that fourth wave in and we start to rally, then we're looking again, right? What are we really balancing the rally at? Well, we're going to start to go into earnings, right? We've been talking about it. I think we got enough going on right now. Even there's some nasty stuff going on in the Ukraine right now. Uh, we know we're supposed to get a peace deal between Israel and Hamas. Is it signed, sealed, and delivered? Not yet. Do we have any economic things that really could start to bust open? We do. Maybe not so strongly, maybe not so severely. But the government shut down, so we have no idea what employment status was for September. Don't know. Haven't been released to come. So we have things still out there that could give us a quick drop. Um, October the 14th, we start earnings. Again, just to kind of go through, we're really not going to drop into our earnings until almost, let me see, what do we got? The 22nd, and it's an estimate. The Tesla will report on the 22nd of October. Google report on the 28th. FOMC meeting on the 29th and the 30th. Also, Microsoft and Meta on the 29th. Apple and Amazon on the 30th. NVIDIA comes in November. So that November window, right, goes out to that date, to like November the 19th, right? And then maybe NVIDIA comes out and gives us a little shock. Now, then I think then it's over. So I'm thinking before then, we've got to finish this and turn. And so I think these earnings will help a turn. Because if we go all the way to the end of October, now it might throw the balance off. And then again, I rerun the algo. Every time you get updates, you rerun your algorithm to see what changes may have come in. Because this is all math, folks. Probability math, everything. Volatility remaining constant. Beta not changing. So there's a lot of givens that are here that can become variable. All right, but right now we have what we have. So again, going back out to the daily, we have on here our right tails for the bullish picture, 71.40, 74.80. We already went over that. We have the other side also in, going over that, 64.60, 61.20, all realistic. So 64.60 I like a lot. Comes in, we're in that fourth wave inside of it, and to actually the upside of it, but still not that far to where we got to come down 300 points. I think we can do it and then start to rally again. before the bulk of these earnings start to come out. Okay, so that's that. Let's jump. Let's go over to the spiders. I actually filled in the spiders here for us, or for me, in putting together the entire picture. So again, on the big picture, same, everything's the same. We reached our minor fourth wave on April the 7th. And so we're in that minor five. And here's one, two, three. We're inside of minute wave four. We had an irregular, and here's our left tail. Now, these I left in minute because that's what I'm expecting. When we're done, I'm expecting a minute fifth wave to take us up. These are the levels for the minor fifth wave. But we're seeing where that minute fifth wave starts to come in. All right, so we got these levels. Now let's take a look at them. Again, the right tail, the 5%. Now everything remains the same, right? All the earnings, and we're looking at percentiles, the 5th, the 25th, the 50th percentile, right? Within that, how many are with, and what they're really looking at. Now, I have to tell you, the bullish side, the percentile jumps the 75th percentile, the 95th percentile. And that is really a number that I'm not actually including here. But there, we're really looking at, based in US dollars, if we get up into that percentile, the 75th percentile comes in at 735. Spiders, 735. It's up in here. And that has almost a 10%. There's your 10%. It's 9.85. This is 75th percentile. You round it up. 75, 755, 78, 756, up in there. Now, 5% really drops. It's not even showing, but it's going to be between the 50th and the 75th percentile. And that comes in at 701. Here we have this, our fibs. Now, yeah, I kind of fibbed it there. 3.39, that doesn't exist. 3.382 does, but I wanted to get as close as I could. So I had to up it a little bit to show you what this is on a fib basis. It's 3.39, not 3.382. I could put 382 there and say it exceeded it by a little bit, and that would be fine. But we'd see it all the time. Now, downside doesn't look that bad. Does not look that bad at all. Again, our left tail, which falls in actually probably about 30% percentile, because 5% is 635.45. 6.27%, almost 6.3%, is 626, 627. That's where you can drop down, right? And look where that's 2.36, 23.6% retracement for minute five, minute four comes in at 629. Well, we got the left tail at 5% at 635. We got 2.618 for the C wave. Let me bring this. I got to leave this open for that so I can read my numbers. We have 2.618 at 638. We've got the left tail, the 5%, which has a pretty good probability, by the way, a very nice probability of 38.5, 38, almost 39% probability of occurring. 635, 2.618, 638. Wow, those match. 23.6 on the fourth wave, 629. Wow, we have a cluster. We have a cluster to complete wave four and not a catastrophe, and all within that fourth wave of one lesser degree. We got a higher probability here, and this one is telling us that. The algorithm is telling us we have a 38 7.5% probability of getting here. That window, it, to me, goes from here to here. I like it. Now we can go the full board, the 10%, right? So we get something really nasty coming out, and that 10% is actually um, is excuse me, this was wrong. My percentage is wrong. I'm wrong. It's a 30%, which is still pretty good. Getting here. I'm on my left tail. I was reading the right side tail. So 30% probability of it getting down there. Now, to go to the 10% window, we have a 15.3% probability of getting down into this window, which is 605. Not so bad. 38% retracement for the fourth wave is 606. So we managed to stay above 600. Not bad. Not bad. And if something negative were to come out, I think that's going to contain it, to be honest with you. But if it's something that might be turning geopolitical or getting more severe, then I think we can get here. But I think that all holds. Then we start to rally. And here's our other side. So in the spiders, top side. Now, again, I will get it right this time. A 5% upside move has a 38.5% probability of occurring between now and mid-November. And that is at 701.45. And where are fibs? There we have one. 701.25 is almost 3.382. So here we have it. 3.382 plus the 5%, which has a, oh, get that, has a 38.5% probability. So it's pretty high. So this one I like a lot. Then if we get great earnings or the Fed makes another move, the 10% has almost a 25% probability of coming through. And that's at 755.78. And that's just above 3.882, which is at 733. So that's another 20 points between friends. So I think we got windows here. Our first window up into here, all the way down. Our second window to the upside, our second window is, our first window is here. Our second window is here. And I think that then again, to the downside, it's completing minute wave 4. To the upside, it's completing minute wave 5, but also minor wave 5, intermediate wave 5, primary wave 5, and cycle wave 3. All coming in before December, coming in towards December the 10th. And then we start to decline to the year end. And then it could build. From there, we could build. We're only talking about, starting to get bearish from December the 10th on. That's it, folks. A lot of talking, a lot of algorithm, a lot of work. I want to thank you for taking the time to listen. And if you listened through the whole thing, fantastic. You're picking up a lot of information that hopefully will be useful, and I will continue to make reference to as this all moves forward. Okay, so in the spiders, we got the A, we got the B. I believe the B also finished here on Friday, and we're starting to move down. 100%, 659, or 660 would be our first level. That's the 100% marker. I only think it's going to be support, a pause, might be wave 3, and then we get a 4 and a 5. 1.618, also likely, but it's 651.60, but it could complete because we're below. It's after that we start to get our left tails coming in here, and then 2.618, 638, 23.6 on the fourth wave, 629. And then we also have our left tails all in here as well. And we have our right tails above us. So up in here. So, and again, excuse me, we have the left tails here. 660, I think, no, I don't know what it is. On the spiders, right tails, left tails, 635, 45, and 605. 35 right there. So in between 236 and there, and just within, oh, right at the bottom. Look at the low. The low of the previous fourth is 635. That right tail comes in at 635.45. Wow, that is that low of previous fourth. Wow, pretty cool. And that is the 5%, which has to the downside a 29% probability of happening. So wow, okay, 635 in the spiders. And to the upside, we saw it. It's up here. And we have 10% move, 25%, 5% move, 38%. Wow, up in here. So yeah, I think those are pretty good, and that gives us the path. All right, so I am going to cut it right there because now I've been talking for a long time. And thank you again. And I'm hoping that you guys will listen to this because there's a lot of information. Next update will be on Monday morning.